So what are the tax benefits of the LLC? How is it taxed? And how does an LLC help save you money in taxes? Now, the LLC started in the United States in 1977 in Wyoming. The challenge was that the IRS was not clear on how they were going to tax them, so the IRS taxed them as corporations. In fact, I wrote one of the first books on LLCs in 1995. Then in the same year, the IRS and the Treasury Department announced in Notice 95-14 to simplify the taxation and let the taxpayer choose whether it is taxed as a sole proprietorship, partnership, or corporation. Many call this the check the box regulations because on the Form 8832, you can check a box to choose how your LLC is taxed. And the IRS made these changes final on January 1st, 1997. Hi, I'm the business guy, and we're going to talk about how the LLC is taxed. I've been in the company formation field since 1991. Our company started in 1906. We have attorneys on our staff and employees nationwide. And if you're watching this on YouTube, please click the like button below and enter your comments. And you can also click the subscribe button so that when more videos come out like this, you'll get notified. Okay, now there are generally 4 ways that an LLC is taxed. The first way that an LLC is taxed is as a sole proprietorship. Now with an LLC, owners are called members. So when we form an LLC for a client, and that client is the only member, by default, the IRS taxes that company as a sole proprietorship. Another term for this type of taxation is a disregarded entity, and that is because there's no tax at the company level. The LLC typically uses your own Social Security number as its tax ID number. The income and deductions are reported on your personal tax returns as if the company didn't exist. So the first way an LLC is taxed is as a sole proprietorship, also called a disregarded entity by default if it only has one member. The second way an LLC is taxed is as a partnership. When we form an LLC for a client, and that LLC has 2 or more members, by default, the IRS treats that LLC as a partnership for taxation purposes. That means the company does not pay its own income taxes. Instead, the income and deductions flow through the company to the tax returns of the members. Then the members pay the taxes on their own personal tax returns, typically in proportion to their percentage of membership interest. So let's say John owns 70% of the company and Sally owns 30% of the company. After all deductions, the LLC makes $100,000 for the year. So John will pay taxes on $70,000 of that income, and Sally pays taxes on $30,000 of that income. And with a sole proprietorship or partnership, the members pay the taxes whether the money is moved from the company's bank account to their personal bank accounts or not. So in the above example, if John and Sally leave the entire $100,000 profit in the LLC's bank account, or they transfer some or all of the $100,000 from the LLC's bank account to John and Sally's personal bank accounts, the tax that John and Sally owe to the IRS is exactly the same. And that is because there is no tax at the company level on a sole proprietorship or partnership. All taxes are paid by the members of the LLC. Now this part is very important for you to understand. To keep in mind the legal protection that the LLC gives and how it is taxed is in 2 separate buckets. So say somebody sues your business, not you personally, but your LLC. LLC statutes can protect your personal assets from that business lawsuit. So structured properly, the LLC can protect you from somebody seizing your bank account, your house, your cars, and it can provide this legal protection regardless of how your LLC is taxed. On the other hand, a regular sole proprietorship or partnership that you own does not protect your personal assets from business lawsuits. But an LLC can still protect you regardless of how it's taxed. So an LLC taxed as a sole proprietorship or partnership can protect you just as much as an LLC taxed in any other fashion. So how it is taxed does not change how it protects you. So a business that is a sole proprietorship or partnership is very different than the protection that an LLC gives you that is taxed as a sole proprietorship or partnership. So by default, if an LLC has one member, it is taxed as a sole proprietorship. If it has 2 members or more, it is taxed as a partnership by default. And when we say by default, that means for a U.S. LLC, you do not need to file the 8832 form for your LLC in order to be taxed in one of those fashions. Now, CPAs do recommend that you fill out an 8832 form for an offshore LLC to be taxed as a sole proprietorship or partnership to clarify how you want the IRS to treat your offshore LLC. Now, you would likely want your LLC to be taxed in one of these ways when it owns real estate. Now, there are a lot of tax deductions you can get with real estate, so you would likely want to take advantage of those tax deductions to reduce your personal income taxes. A third option you can choose is to have your LLC taxed as a C corporation. And you do this by filling out an 8832 form and checking the box, electing corporation taxation. So with this type of taxation, your LLC is taxed as a C corporation. It pays taxes on the profit the company earns before the end of its tax year. So the money that the LLC pays you as a salary is taxable to you personally, but tax deductible to your LLC. Then the IRS taxes the profit remaining in the LLC by the end of its tax year at the then current corporate income tax rates. Now, taxed as a corporation is the least popular taxation method for LLCs. Now, you might choose this method of taxation if you want to raise money by taking your company public. Or let's say you want to choose a different month than December for your tax year end, or your only employees are immediate family members and you have substantial medical expenses to deduct that the company pays as an employee benefit. Now, it's not a good choice if you operate a personal services corporation, because if you accumulate money in the company, it could trigger a 20% accumulated earnings tax. The fourth way that you can choose to have your LLC taxed is as an S corporation. To elect the S corporation, you first file the 8832 form with the IRS and choose corporation taxation. You then file the 2553 form and elect S corporation taxation. You can pay a small but reasonable salary from an LLC taxed as an S corporation. Then you pay the remainder of the money as a distribution to shareholders, which is not subject to Social Security, currently at 12.4%, and Medicare tax, currently at 2.9%. So you can save a combined 15.3%, also called the self-employment tax, on a large chunk of your income. Now, you don't need to do this when your LLC owns rental income property, since you do not generally pay Social Security or Medicare on rental income anyway. So no need to choose S corporation status for rental property. Plus, Section 469C of the tax code says if more than 25% of an S corporation's income is considered passive, such as rental income, the IRS can tax that income at C corporation tax rates and eliminate its S corporation status. So you would most likely want the S corporation status when running a business with ordinary income, such as operating a restaurant, so you can save money on self-employment tax on a large chunk of your income. To review, your LLC can be taxed as a sole proprietorship or partnership by default, which is great for real estate investors. You can choose the C corporation status so the LLC pays its own taxes, or you can choose the S corporation status for a business with active income to save money on self-employment taxes. Now, I hope you found this video valuable. Please share this video with others and click on the like button. And if you want to set up an LLC, visit companiesinc.com and give us a call or fill out a free consultation form. This is The Business Guy.